Good morning and welcome to today's Simply Protect web conference, where today we'll be taking a deeper look into market innovations and also the changing welfare state. Today with me I have four guests. Over onto my left I have Nick Telfer, Technical Product Manager from Vitality. I have Emma Davis, Intermediary Development Manager from Legal & General. I have Martin Lyons next to me, Head of Business Development at Partnership. And on the end we have Mark Richards, National Account Development Manager for Aviva Incorporating Friends Life. The session will last approximately 1 hour, and always we would like your interaction with us, so feel free to send through any questions as we move through the session and we'll ask them to the panel as we go. Okay, let's start off. There's a lot of change happening in the welfare state. We're seeing a lot of questions coming up in the Houses of Parliament, a lot of blocking. Do we think that it's still a bit of a dark art? Do we really understand as advisors how long a client can actually last if they are made unemployed or are ill? If I can pass it on to you, Emma, first.
Yeah, I think it is constantly changing and there are new messages every day. We know that the government will provide fewer benefits for households going forward into the future. One of the tools that Legal & General does provide, as with a number of our providers here, is research that we've actually carried out looking specifically at the deadline to breadline, and the average UK household now can only last 29 days before it reaches breadline. The other daunting fact is that 60% of general household populations don't understand what they will actually receive from the state, so they haven't got any idea, and a third of those have no safety net at all put in place to actually protect themselves should the worst happen, whether they fall ill, suffer critical illnesses or ultimately were to suffer death, unfortunately. And we know costs of living are increasing, savings are reducing. The average household only has approximately £1,200, which is why those customers would be at the deadline much sooner. So it is an impact, I think, and there is support out there, but I think it's raising that awareness with customers about how those benefits are shrinking and the need to protect themselves more.
Thank you, Emma. Mark, is there any additional information out there that could help?
I mean, there is a lot, as Emma said, and there's different providers offering different aids, whether it be specific sales aids by way of tools such as budget planners, other information about the marketplace. But I think a lot of it just still comes right back to sales process and having a defined route that advisors follow to make sure protection is put on the agenda, but clients understand how it can protect their financial independence. So if they are looking to become, financially independent in their mid-50s, how are they going to achieve those objectives? So it's all basic stuff that we all know, but I think it's just getting back into good habits of following that right process. I mean, Aviva's recently done their family finances review that's very similar to deadline to the breadline. And again, there's very similar stats that have come out of that. But I think, again, as an industry, we all know that at times we do become a bit punch drunk with, don't go out today because of. But the challenge I think we have nowadays is we all have very high expectations about our lifestyles. And we are living longer. There are more amazing medical innovations that are taking place, but they're costly. So again, if we're going to maintain those lifestyles, we need to be able to make sure we have that right safety net in place. So I think, again, with protection, as we know, it's one of these, it won't happen to me. I don't particularly want to invest in it. Whereas with pensions and investments, people can see the positives of going forward. What we need to do is just make sure we do marry those two together. Yeah.
Okay. And how do we support those conversations? What can the providers do to help members with that? I'll go back to you, Mark, on that.
I mean, I think with that, again, there could be guidance, whether it be sales training videos about soft skills, because again, with the industry, if you go back a number of years, soft skills are very high on the agenda of consultative selling, whereas nowadays, because of compliance, and we readily accept we all need to be compliant, but at times, unfortunately, some of the discussion areas that advisors will have with clients may have been lost because there's so much emphasis on hard facts and completing fact finds. So there is a lot of information available from many providers, whether it be video training, whether it be face-to-face training, whether it be things such as objection handling. There's a range of tools available out there, And what I would urge is for any advisor, any member to actually get in touch with their local account manager, their provider, and if there is training that they want, whether it's online, video, face-to-face, I know that the industry is there to support and help.
Mm-hmm. I'll come on to Martin if I may at this one. How can we help the advisors actually get better conversion rates within the mortgage market? Is there a thing now of, is everybody virtually insurable?
No, I mean, one of the challenges I think is, you get the rates up on whatever portal it might be, and then actually getting the rates sometimes isn't as easy as you think it might be. And I think tied in with the fact that we've just been talking about the need for people to have cover and the circumstances whereby, I think it's in the vulnerability paper that's just come out, the number of people that couldn't cope with an unexpected bill of, I think it was £300. It's about 50% of individuals or something of that nature. So not to be able to cover your mortgage because you can't get cover would be a real concern for those individuals. Those real high costs, let alone family protection and everything else. So I think one of the things that where an advisor can really add value is to look at providers that aren't necessarily mainstream. So where people can't get life cover for medical lifestyle reasons, I mean, in our example, we offer a cover to people who've been declined. So from a TCF perspective, making sure you have explored every avenue from that perspective is something that an advisor can do, which an individual on their own might not necessarily know that there are specialist providers out there. So a lot of people do look to be uninsurable, and there are even cases that we wouldn't necessarily take on, but nevertheless, by seeing an advisor, then people can go that extra step and say, well, look, let's shop around a little bit further. I mean, one of the other things coming out of the vulnerability paper is OP8 was if people don't get access to these kind of things, there is the risk that people, if they don't fit into the mainstream market, may then become more vulnerable because they can't get the mainstream products that everyone else can. And so that particular paper is very wide-reaching. So that's where we fit. So, and and I know other providers, will look at different illnesses and different circumstances differently. Certainly as a if they can't get cover, then we'll.
So are we sort of trying to say that we shouldn't just rely on the sourcing systems, maybe, Nick? Is it going past that and actually understanding what's underneath that pound sign?
Yeah, I think that's one of. I often describe our market, the protection market, as being dysfunctional, and there's a number of reasons for that. First one is that people are buying the least likely product that they're ever going to claim on, term assurance. We should be looking at whole of life cover. We should be looking at morbidity cover against illness. That's much more likely to happen. As Mark said, people are living longer, and they're not necessarily living longer in good health. And there is a market there for people. Most people can get insurance. They always say there's a price for everything, and there is. But the sourcing systems, one of the big dysfunctions in our market is the focus on price. And in a lot of ways, what our market is doing is trying to sell the customer the cheapest product we've got in the shop. And I don't know a shop I go into where the guy behind the counter tries to sell me the cheapest product. And I think that's something we can change by adding value to products, developing differentiated propositions that help advisors in the advice process, because advice is absolutely key. People aren't going to go out and buy protection insurance. People, if you think about it, what we're selling people is something they never want to use.
Absolutely.
And that takes some sales skills, and we all offer training to advisors if they want to get into or improve their protection sales, and we're here for you.
It is back again, isn't it, to the members, the advisors are the experts, and what we mustn't do is forget that, whereas, as you rightly say, the public, they're not sure what they need, when they might need it, what's the criteria I should use for selection. But the market has become very, very complex over the past 20, 25 years with the advent of things like critical illness, serious illness within the marketplace. And but there are tools out there, going back to what support's available. So you have the portals looking at price. You have other tools that might be available, such as CI Expert, that will help people try and get an overview of the marketplace. So I do think there's a lot of tools out there to support people, but the education is still needed. So hopefully that way the client can make an informed choice. So the advisor can say, you know, this is what I'd recommend, but actually there's a range of solutions available, and to get the client invested so they can get involved in part of that discussion. So hopefully that way they recognise, if I do pay some money, I know what I'm getting and I know the value I'm getting from it, which I think is, you know, is crucial.
Well, I think the choice of provider is actually, that's the last piece in the jigsaw. That's the bit that, and I think we've got to, where we as providers can help is helping advisors get the other bits of the jigsaw in place in terms of what does that customer, what have they got now, what do they want to achieve, and how do we get there, and then almost which provider provides the cover is to some degree irrelevant there. It's getting that customer to understand the need that's important.
And how do we, because in effect you're turning the sales process on its head a little bit, aren't you? Because we're telling them, or we're trying to talk to a client to say that the most expensive product is probably the best product for them, because it's expensive normally because it gets claimed on more often. Yet they're probably seeing aggregation sites or adverts on the cable channels that say get life insurance for, you know, £3.50. It's how do we turn that round? So I don't know, Emma, if you've got any ideas on how we can help change that sale round?
Yeah, I think, and we are seeing more and more aggregators advertising and running big marketing campaigns. I mean, the latest one is Nicole Kidman, isn't it, with Compare the Market. You know, and that's obviously part of the big life insurance industry side of things. I think it is, whilst an element of that will raise awareness with customers to think about life insurance, I think what there needs to be perhaps is more focus on the requirement for the advice, as you say. You know, do what customers want to put a policy in trust? You know, what's the purpose of that protection? Is it simple mortgage protection? Well, depending on the customer's circumstances, there could still be a need to write that mortgage protection plan in trust. You know, inheritance tax is much more complex and should have advice. That doesn't tend to be promoted in the aggregator site, but I think there is a bit of an underlying message with those adverts that it's very simple, but the reality is, and we've experienced this with our direct sales, is it's about making sure that there is as much information up front so the customer knows what they're buying, because often they don't. They might just choose to buy their life assurance because that is that simple route. They know that, like you say, it's probably the first and foremost thing they might think of if I'm going to die. But the reality is, I think it's about better marketing campaigns and support to bring in the awareness of the morbidity side, the critical illness, the serious illnesses, because that is, if you like, one of the biggest gaps where customers aren't buying. They might buy term assurance because they can see that end game even though they don't want to. But it is I think any direct style marketing campaign will support the message because it will raise the profile with customers. But I think what we need to do really is address the fact that we need to turn those customers to real advice so that they're getting what they should have, not just buying something quick and cheap. And I think that's often the difficulty in making sure that those messages lead back to seek financial advice.
And how do we get that out into the market? Obviously Aviva with their Paul Whitehouse advert, it was very strong, the first one, I think probably 3-4 years ago now, when they were all looking for the passports. But it's one of those, it's very strong the first time you see it. The second time you see it, you go, yeah, I know what that's about. So how do we keep getting those messages out to the consumer so that they understand that insurance is not, it's a necessity rather than, well, we best have that just to cover the mortgage?
It's in my opinion, again, it's still back to the advisors. It's advisors being passionate. It's building it into the sales process in a way so that it's a bit more of a throwaway, because it is so essential to good financial planning. But I think also it's getting people to understand how good value for money protection can be, that it's not, perhaps as they might perceive to be, very expensive. And it's getting this balance so they understand actually for a few pounds a week or a month, actually it will give me this tremendous benefit, which then means I can protect my lifestyle. So a very quick basic example, somebody earning £25,000 who's about 30, if they were off ill, if they got the ACES support, it's about £5,600 a year. So net income £20,000, if they're getting £5,600, a huge gap in income. To plug that with income protection, 3 months deferred, would cost around £5 a week. So for me, if you're saying, right, you have a lifestyle, whatever it might be, and you want to protect it, actually, let's call it £1 a day, is that much to pay to actually retain that lifestyle? And I think it is, again, just trying to get the client invested. So we're not talking about income protection or life cover. It's lifestyle. If you want to protect your lifestyle, we can help. And this is what I recommend that you do, because actually I'm the expert, and what I hope is that if I've positioned things correctly on the sales journey, the client will understand the benefits of having cover.
So I like how you took it down to virtually the £1 a day. Is that something that is a good idea to do? Because I've seen it before where people say, well, that's less than a Starbucks or a Costa. There are obviously other coffee houses about, but you know, that they bring it back to something that's tangible that the client, because if you've got an income protection policy that is £80 plus a month, that just seems expensive to the client when they've, as I go back to, they've seen that advert for £10 life insurance, even though it's a different product. The perception is it's still protection in their eyes. So is that a good sales tip, bringing it back to a daily amount?
I think what we've got to remember is who our competition are. And okay, we're competing in a market, but our competition are the likes of Sky, BT, all those, Vodafone, whoever it might be. They're our competition. They're the companies who are appealing to customers. They're the ones who are taking money out of their bank accounts. And we've got to have propositions that stack up against them in the 21st century, because you know, we can't just rely on people having that belief that they need protection. They've got to be advised. And yeah, I keep saying it, but advice is absolutely critical here. And yeah, if we can, we play a massive role as an industry in terms of taking strain off the government, off local authorities, and I think we should be prouder about what we do as well, because that's an important part of that, helping people provide their own safety net, rather than having to be reliant on the state, because that gives them choice, and choice is the most important thing.
I mean, I can remember going back some years, and I think it still rings true today, is that those advisors who have experience, for example, of having seen claims, you know, even in our age group here, I'm sure, you know, I know several people that have had heart attacks, you know, in the 40s, this kind of thing, and what would have happened if they hadn't have had cover, or somebody didn't take PHI and now they've had to fall back on X amount a week, and you know, how are they coping with that kind of thing. Personalising it to actual experiences is something that you can't get off not very easily get off a TV advertising a Parker pen or whatever it might be. You know, and I think it's that, as you say, that soft skills and just really bringing it home to personal experience, really, and getting all those messages across.
I think, as Mark mentioned as well earlier, the sales process, I mean, you know, it could be the importance of just going back to the basics of how we used to ask for referrals instead of spreading the word amongst friends and family. And because if a customer has recognised the need and taken out that cover, then yeah, are those processes still very active in saying, well, you know, you've recognised the need, you can see the importance, who can I speak to, or have you got any friends that you think would actually also value the same advice? Because unfortunately the government aren't going to go out there and put a billboard up on the television and say, go and seek financial advice because we're not going to cover you in the long run.
But it's a real task to do, I think, because you haven't got that industrial branch type scenario as well, have you, anymore? Where people were getting the first thing was, you know, well, it is literally just a few pounds sometimes, isn't it, to get the level of cover, but people aren't necessarily being advised in the same way that they were advised previously, you know, and so, you know, that starting point, people even starting just to buy a little bit of cover, is starting at a much higher level, I suppose, and you know, not in the same way that it used to be done. So I guess that's part of the reason why a lot of people don't have enough life cover.
I think they also, there can be the assumption that people won't be interested in talking about covers, which again can be the sort of discussion that we're having, whereas, as we all know, there'll be many shades of different types of clients that might have very different drivers and things that will motivate them. And that's why I think, again, you know, members, the advisors, you are the experts, and actually you have the toolkit to actually engage with your clients to then actually give them the opportunity to make that informed choice. And there's information that's come through with I mentioned earlier, the family finances, where an immense number of people are very concerned about the potential impact of certain illnesses and the impact that could have on their financial independence. So that for me is a big tick in the box of, hang on a minute, the audience might be a bit warmer than we perceive them to be. Therefore, if you do have that conversation, hopefully they will listen. But it's back again to, as you were saying, not necessarily the £80, it's fine, it's being sensible, using a budget planner, and again allowing the client, demonstrating the client, there's a range, there's a portfolio of protection they should consider. Let's try and find the right package for you, based on need, based on options, and if my recommendation is it is £80 a month, but you can only afford currently £30 a month, well, let's try and do what you can do right now, and we'll revisit it in a year's time. It's
And the £30 will buy them a lot more cover. I mean, Aviva did some research a few years back, and you had what people's perception of cost was.
Yes.
And then you told them that it was far, far low. It might have been 80 down
Yeah.
to 30 in some of the examples, if I remember correctly. And people, overestimate the cost of these things, don't they?
We're not very good as an industry at testing the client budget. I think we perhaps roll over too easy, and someone says, I've got £20, we accept that.
Yeah.
And that's one of the reasons why we've introduced the Vitality programme, because that helps have a different conversation around budget. And these are what these added value benefits that we have bring to the party. It allows the advisor to have a conversation away from just the cheapest.
Yes.
Because if you look at a lot of advice processes, if you don't sell the cheapest product, you've got to do a lot of work as an advisor to justify why not. I think that's wrong. I think the justification should be, why haven't you sold the best product? And you should be justifying that. I think we've got a long way to go there in terms of changing the mindset, but that would help us. People are worried about over-insurance for some reason. I don't think any customer would be worried about or any widow would be worried about her husband being over-insured. I think it's affordability, not price, that's the important thing.
Before I move it into the added benefits, I think that's quite good. And don't forget, send in your questions and we'll read them out and ask the panel. You mentioned the added benefits. Obviously, again, I think this is where we can show our knowledge above the aggregator site. So you've got your Vitality, which I'm sure you can talk about in a bit more depth for us in a while. But you've also got Red Arc, you've also got Global Treatment. There's lots of things that either are free, in effect they come with the policy, or they're a couple of pound a month that, again, in my view, need to be explained and expressed more to the client. Actually, do you know what you're getting? And that's included within that price. Whether you say it's free is a different matter, but it's within that price, which in some cases could be thousands of pounds worth of benefits, couldn't it?
It could. And I think, again, it goes back to what we're talking about, that quite often the expectation is that the client will be rather underwhelmed if one's talking about protection. Therefore, do I really want to have this conversation? Whereas I think, again, I know most of us, if not all of us around this table, are pretty passionate about protection, what it can do. And I'm sure that most advisors out there are pretty passionate about what it can do. It's just being able to convey that to the client. And I'm of the belief, having been around for many years, that, as you rightly said, if you've dealt with a claim, my goodness, the difference it makes to your outlook. It really does strengthen your belief and passion and pride about what the industry can do. So I do think there's a lot of components that are included, as you said, Martin, at no cost. There might be others that might be a very modest add-on as an option. But I think, again, we can be assumptive as to the value we think the client may place on that. And for me, again, as you said, Nick, for me, people shouldn't be worried about giving people more, because actually generally people need that level of cover. The average, I think, critical illness sum assured in the UK is around £60,000, which, if you think about the average mortgage, you think about if you haven't got an income, how much money would you need? Critical illness is talked about an awful lot, but if that is the average sum assured, my goodness, it falls short, doesn't it, of perhaps what people need. So I do think, again, it goes back to what Nick says about price. The perception could be, that's the base, but if you want something else, it's going to cost a bit more. Should we actually be then moving to the next level of price? Whereas I know, banging the Friends Life drum for a minute, the global treatment option that Friends have, I think it's immensely good value for money. And I believe that if I were an advisor or me talking to a client about it, I think it's worth an awful lot more money than currently it's being offered for. but that is because I have a real belief in it, and I hope many of your members also have a real belief in it. But it's conveying that to the client and again allowing them to make that choice. If we don't talk about it and we don't explain, they won't be in that position. And that responsibility to educate advisors obviously sits with us as providers to make sure that they have the tools to do that work and hopefully educate clients.
And Nick, have you got a sort of pound sign figure of what you think Vitality is worth, as in all the extras around the edge, to an average client?
Well, you can quantify it in different ways, but I mean, if you look at a free cinema ticket every week, if you look at half-price gym membership and a half-price pair of trainers every year, that's adding up to hundreds of pounds. And not everybody's going to use all the benefits, but what to me it brings is immediate benefit to the customer. You know, our product, as I said earlier, everything's normally predicated. The benefit is predicated on something bad happening. What we're trying to do is give people something when something good happens, and yeah, it doesn't take much for someone to be going. If you go to the cinema once a month as a couple, let's say that's £240 a year. Okay, so that helps the advisor in terms of extending the conversation about the budget. What it's there to do is allow the customer to be able to afford the cover they need today. That's what we're trying to do, and it's another tool for the advisor. And if that doesn't work, then something like global treatment cover appeals to the customer. Then there are all these benefits out there which do, and you know, if we don't differentiate, if we just pay on price and service, then we're playing right in the hands of the aggregators, because that's what they do very, very well, far better than any of us.
Started to have a few questions, which is good. First one, it would be useful to have an option of included a period of unemployment within the policy. Is there anybody that's sort of doing that, or would it have to be a separate ASU policy?
Well, we did have unemployment cover with a third party in our plan as a benefit. But I mean that became unaffordable. These are annually renewable general insurance contracts. Yeah, I ask actuaries whether we could do those as a long-term contract, and their hair goes white overnight. It's a very, very volatile benefit. We've got to focus on illness. Illness can have equally, if not more, catastrophic effects on people's finances than unemployment. Unemployment will tend to be temporary. Illness can be a very long-term thing. That's what we should be focusing on.
Is there a matter of using that though as an ASU policy as a short-term part before an income protection kicks in? So actually have a deferred period that's covered with an ASU policy that comes in straight away, so the client isn't having to wait, and or can keep the costs slightly lower by taking a longer deferred period.
Yeah, I think that's definitely an option, because certainly merging the two is something as well that we've sort of considered and looked at. But like you say, they're underwritten very differently and priced very differently, and it is a bit of a nightmare. But yeah, I think having that whether it's ASU or even the AS element, with then tied into a longer term deferred period on IPB, can be very, very well, not cost saving, but it can be very more cost efficient for a customer to do that, and then they've got both of those elements covered. So yeah, I think that is a definite option that should be looked at as part of the advice process.
Okay. Question about the sales process. A couple of questions have come up about when it doesn't touch the sides, it's fantastic. When it does, it can be a little tortuous occasionally. Not to throw this one straight at your mind, but obviously most of yours, I'm guessing, because of the nature of the lives that you're protecting, would not be the norm. So how do you sort of make that process as seamless as possible while still making sure that you've got all the information that you need?
Yeah, we're pretty flexible on it, because it's very niche in terms of what we do, and so ordinarily we're looking at people who have been declined for various reasons. I mean, they may have had a critical illness cover and now find, oh, hang on a minute, that was the whole policy. They didn't do two separate ones and now can't get cover, or whatever it might be. Where they have obviously shopped around because, looking at where they can get the cover from a standard rate provider, and where that's been declined, we'll take a copy of that application form, so they can send that through to us first, so we can sort of start underwriting based on that. Obviously share medical evidence, as I'm sure the providers generally do anyway, to really try and make sure that the client isn't put to any more kind of hassle and stress that they've already gone through. So yeah, we try and make it as smooth as possible from that perspective, and start underwriting at the earliest point on whatever information that can be provided.
And this is open to everybody. Is there a perception out there of a continual requirement to keep asking further questions? So are you a one-hit question provider, or do you regularly ask supplementary questions? I think sometimes that can be the feeling of, why didn't you ask that at the start? Sometimes there is supplementary off the information that you give, but sometimes, and we get it on a lot of the other types of products, not just protection, where supplementary questions come afterwards that could have been asked at the start.
I think it's difficult to standardise that with everybody's medical circumstances being different. You know, that with protection, then the underwriting is done up front. So at least at point of claim, we've gathered as much information. We've ruled out non-disclosure wherever possible. And yeah, point of sale systems, you know, between 70 and 80%, many sort of, like you say, go straight through and don't need any additional information. I think there's a positive spin on requiring medicals. You know, if you can say to a customer, actually it's a free health check, you know, and put that positive on it rather than, oh God, you've got to go for a medical. You know, we all offer telemedical interviews to try and avoid that more in-depth information. But I think, in essence, for the majority of us, you know, if we have to do it, we have to do it because we want to ensure that our claims record is very good. And we're not going to put the customer through any unnecessary uncertainty at point of claim when they really don't want it. So we'd rather be thorough, I think, you know, rather than sort of considering it as an onerous journey. We recognise that some are much more difficult. They do require more information, specialised tests. But yeah, I don't think we can standardise that because it's very individual to the individual circumstances.
I think it's important what you said there, actually, because the point that people having a medical, you can put a spin on it if you like. That's a positive. And one of the big problems we have in our society is that people don't know how healthy or unhealthy they are. So at least that gives them that opportunity to understand that. And often, you know, advisors will be disappointed in customers with a loading. But that's telling that customer they actually need the cover more than the average person needs it. So again, these, you know, sometimes these negatives can be turned into positives around the whole underwriting process. It's fundamental to what we do, and it's another area where we can differentiate, and the advisor can add value by knowing, well, with that particular condition, that company treats it differently to the rest, and again, it's an opportunity for the advisor to add value.
Is that also understanding from an advisor point of view when to submit that application? Because I'm guessing if it's a mortgage, if it's related to a mortgage, sometimes the application doesn't come in until maybe at offer stage of the mortgage, so that they know that they've got the mortgage. I know we could debate they probably need the cover anyway, irrespective of whether there's a mortgage attached to it, as we've discussed before, but could that help by that application coming in a bit quicker, because then you haven't got the rush to we need it for completion?
I think again it's a couple of things. I think first and foremost is we need to make sure that advisors understand our processes, what we do, how we do it. It could, as Nick says, extend into perhaps underwriting tolerances, what we'd like to do in certain circumstances. That then hopefully means the advisor can manage the client's expectations. So this is what you should be aware is likely to happen. You know, other information may be needed, etc., etc. And I think if people know that, then it's not a surprise, which again goes back to aggregators, and all I expect to do is click on a button and then I get the policy. Whereas actually this is so important. As Emma says, it's better to be thorough at day one, knowing that everything is done as it should be. You can then forget about it. So if, God forbid, anything does happen, the policy will pay out. No ifs, no buts, no worries, which is what it should be about. But again, nowadays, with all the medical advancements that are being made, there are many other tests that are being conducted. So I think in a way, if you perhaps exceed certain sum assured limits, or if you might be of a certain age, there might be a stronger likelihood that perhaps some other information may be needed. And really, again, perhaps look at that positively, that actually your GP is making sure that you're okay. But actually, if that test is being done for the right reasons, tell us about it, and hopefully that way it's just a tick in the box, everything's okay. But we just need to work together. And as Emma said, you know, we want to do it for the right reasons, but it's managing expectations and again, education.
Is that still an issue, getting those doctors' reports? Are they turning them round any quicker?
I don't think so, to be honest with you. If we're honest, I think it's always a one afternoon a month job, I think, for a lot of GPs to do those. If we had an automated medical record system, that would be brilliant, but we don't. So, we have to spend millions and millions of pounds as an industry getting information which often doesn't actually make a difference to the decision that's made. And I think, things are improving. We are all improving our processes daily. We've got the introduction of now these systems like Underwrite Me, which are going to make life easier. Ultimately, one would expect from how they promote it, that whole idea of the single standard common application form becomes almost a reality. And it does make everything easier, but it comes back to the point. If we know that customer's told us everything, we can tell them they are covered. If there's any doubt there, then that's with such a tenuous sort of relationship between the insurer and customer, it's not a particularly solid contract, I don't think.
No.
Certainty needs to be on both sides.
Yeah.
And that's all we're trying to achieve.
It's back to what you said earlier, Martin, mortgage related. It would perhaps be logical to say, right, let's get the offer in and then we'll do the application. However, it might be more prudent to say at the start, to provide, comprehensive mortgage for your needs, we need to put some protection in place as well. But actually, whilst we've got the time, let's just make sure, that we do it now. So just in case, if any other medical information is needed, it will be ready to go when the mortgage actually completes. But again, it's this positioning, isn't it? And the journey you'll take the client on, so they're invested in it. Yeah.
And what happens afterwards as well, if that person is loaded. Again, I'm going to talk about vitality because it can help people get into a position where they're managing their condition and we can remove the loading. It's fair that we have a pricing basis in our industry that takes a snapshot of one day. But a lot can happen after that in both directions. But if it's in a positive direction, people are paying a premium for that. But if they improve their health and well-being, then there are opportunities to reward them. And I know a number of providers will remove loadings, will remove smoker loadings, etc. if people stop smoking. And that's positive. It gives a fairer long-term proposition for the customer.
And a follow-on from that, from one of the members is there any way of getting a standardised medical questionnaire that all providers are happy with that can be sent? Because obviously if you send it to one provider and it's either declined due to something, you then have to declare that on the next application, which there is a perception that automatically adds a loading even if it doesn't. So is there any way that the industry could work together on that?
I think we all have different sets of underwriting questions. I think that's the issue. And then when you have products like the Vitality that cover a much broader range of illnesses than some, those will incorporate very specific questions perhaps in the underwriting journey up front. So I think that, I don't know about anybody else, I think that might prove a little bit difficult to offer that standardised, especially when specialist niche.
Well, that, as I understand, is one of the premises of it, that you just go through one
journey,
one question set, which is basically a conglomeration of all the participating providers. But then you get reflexive questions, and it becomes quite complicated then. But that's, as I understand it, what that system's aiming to do is to provide that seamless journey. It's early days yet, but it's certainly something that we're all watching with interest, I guess.
I suppose the good thing and the bad thing about that is it's good in a way because potentially it could mean it will be more streamlined. It's a one-size-fits-all. The bad thing could be potentially to accommodate that some of the underwriting uniqueness, possibly, of different providers could be diluted to fit in with that process and system. So whereas provider A might be more flexible on, I don't know, body mass index, actually if perhaps you're having to adapt to this system, you may need to change your underwriting outlook. Therefore, actually, that may not then help certain customers because of that underwriting philosophy. So it is, and I think everybody would agree that underwriting is at the heart of what different providers do based on the products that they are offering into the marketplace. Is it more streamlined? Is it more comprehensive? Is there more underwriting flexibility? So there's a whole range of differences, which again comes back down to us educating people so that way they can look at the client, appraise the client, and hopefully then select the best provider.
I think underwriters have different areas of expertise as well. Different providers, they've all got their own different views. So for example, we have a number of cancer specialists, so who will say, well actually if we just get the answer to this extra bit of question, it could actually take your premium from here to here, or it could go, but they need to, need to know, as opposed to just asking more of a blanket question and then just making assumptions. So it depends, and each underwriter will have a different view, and I suppose that's the benefit of having different providers, offering different terms and different specialisms.
I know we always look for a tool that will help us to do this and simplify it. Is there anything out there that would help members understand what the flexibility of each provider is, or is that just an experience of submitting and talking to other advisors?
I think it'd be very difficult. I don't think providers would be very keen on a tool like that because you're going to get picked off. That's a reality, and that window of opportunity to put all your people with high cholesterol with company A would be closed off very quickly. So it has to be a free market, I think, in that respect. I know some of the larger distributors because of the experience they've got, they can perhaps have a clearer view. Why don't networks do that? I don't know. Maybe some do, but those things will change, because if we were particularly good for a particular BMI or a particular demographic, and we'd get all the business in that group, and we want to spread the risk as much as possible.
Is that similar across everybody else?
Yes, I agree. I mean, I think there will be a combination of portfolios that insurers will want to have to balance the book, to balance profitability, and with that, as you've rightly said, you'll have underwriters with different specialism, you'll have pricing actuaries, and all of that pulled together means there'll be a mix of the book that we all want to attract to make sure we can balance it. And given also some of the tools that are available in the marketplace, if insurer A did suddenly start doing a certain type of business, then it will probably become quite apparent quite quickly to the other providers, hang on a minute, something's going on here, because it is such a highly competitive market, and all the statistics and information and MI that is shared within the marketplace. So I think it is this balance, and even though it might be, and I do accept, frustrating at times, perhaps because of time, looking at different insurers, hopefully the long-term benefits are there for everyone, which is manufacturer, distributor, and very importantly, the client.
And what we have to remember with that issue as well is that price is obviously still very important to customers. If suddenly we were to release that information and we were targeting a certain area, it's also the reinsurers that can dictate price to us. So if we're suddenly getting a different look of our book, then they can actually say to us, well, right, okay, because of that element of higher risk, we need to then put our prices up accordingly. So we have to balance it with them as well.
And how would that work with you, Martin, because you are, I suppose, a niche?
Yeah.
You are the flexible bit, I suppose, per se, as a total.
Yeah, I understand SimplyBiz gives some guidance in terms of, where providers might sit in different areas, and there's kind of a...
It's trying to keep that up to date,
exactly.
as Mark says, and Nick says it moves,
Things change,
it's quite a moving feast with pricing, but yes, we try to.
I mean, I can remember years ago, certainly with the mad cow and all that kind of stuff at the time, and people looking at critical illness and saying, well, you cover 50, well, they only cover 49, so that must be better. And I think sometimes, 3 isn't necessarily better than 2, or whatever it might be. More isn't always, necessarily the best thing if it's, they say it's a combination of price and everything else, really. But yeah, ours is a bit more bespoke. So, and as I sort of mentioned earlier, our starting point really is where people have difficulty finding cover anyway. So, in general terms, we're not in that kind of standard rate market where it says, well, partnership are good for this condition or not for that condition, and so on and so forth. We look at everything in the round, but only once, perhaps, or certainly in most cases where individuals have tried elsewhere. There's about 8% of the market are either highly rated or declined, and so that's where our process really starts. Then we're looking at, rather like on the pension side, we look at it very, very individually indeed, rather than saying, well, this is our set criteria and this is where we're good and where we're not so good. It would be more of a rounded kind of situation.
Okay. A bit more of a generalistic question, but also about how an advice that members can use to get multiple covers. So are the tools out in the market that actually help an advisor justify, explain, quantify, especially if it's linked to a mortgage, which is one of the questions, to then tell them and ask the client that they need more cover than they're actually taking for the mortgage?
I think there's a few tools that are out there that are very helpful. Aviva and Friends don't actually offer it, but I know that, for example, I think it's LV and Bright Grey offer a thing called a risk calculator. So with that, again, going back to do people need cover, what that will do is it will very quickly demonstrate the age and the gender of the client, their susceptibility towards long-term disability, suffering critical illness and dying. So for me, that's a very good, practical, efficient tool because it removes completely, will it happen to me? And I know there's a number of members that I work with who are using those tools in that sales process to actually speed up and position what they're doing with the client. If you then look at other facilities available, there are, going back to portals, a number of the portals now, you can you can compare single covers with menu covers. So at least from a compliance and from a speed perspective, you're able to actually say, right, if I recommend more than one cover, is there a compliance but an efficient way actually of looking at the market? You can do that. But then for me, going back to best practice, it is still looking at perhaps a range of options for the client. So a classic being, do we actually just look at income to replace the mortgage commitment, or do we actually look at income to replace all the client's income? My feedback I get from successful advisors that are writing more than one cover is they actually put a range of those options in front of the client. So the client can then recognise, oh, there is a choice. There is a range of options available based on my need, based on my budget. Likewise with life cover, critical illness, do I actually protect all the mortgage? Do I actually look at other vehicles? I think it might have been yourself mentioned family income benefit earlier. So, you know, and I just think if there's a cluster of options, then again the client realises there isn't just that singular solution, there's a range, and within that there's some other ranges. That having been said, obviously as the expert, you need to be able to provide a bit of guidance rather than, my goodness, there's 100 options, it's too complicated.
We have to be careful what we wish for here as well, because if there was a system where you just stuck the customer's information in and then it spat out a recommendation, you're back to square one.
Is that robo-advice in effect?
Exactly. I'm a bit old school here probably. But I think the best tool that any advisor has is a fact find. That's where you unearth those opportunities. That's where you have the conversations with the customer. And certainly the protection advisors that I've come across who are successful, they all use the fact find, all in different ways. They've created their own ways with it, but it's about asking the right questions in the right way, and then the customer, I hadn't thought about that. And you're halfway there, you're over halfway there if the customer comes on your side.
I think the same could be said even of businesses. I mean, what would happen if Bob wasn't here in terms of, from a family perspective, what would happen if Bob's income's not coming in any longer? What would happen if this individual in your business was no longer there? How would the business suffer? And there's a whole other area using a business fact find to look at, what can we do from a business? But there's another massively underinsured area for sort of key personal business protection and all that, those kind of things.
So we mentioned wills earlier, and there's powers of attorney. How many businesses, how many of your members running their own business have got lasting power of attorney and business power of attorney in place? That a business collapses if that key person is unable to function. Personal powers of attorney, these are all things that we talk about putting stuff in trust and wills, and we all understand that. We still find that not enough policies are put in trust. I mean, I think the market average is around 10%, I think, and it always has been, and that's never changed, and we all know it should be probably nearer 90%, if not nearer 100%. But we need to get this advice process into a state where it's going to take the customer right the way through from beginning to end. And it's not so much about products, it's about solutions to need. And I think maybe this was an unintended consequence of regulation. It's forced us down a route of
very hard facts, not necessarily consultative engagement.
Exactly.
And just going back to the tools as well, the deadline to the breadline, although it's not directly linked to mortgage protection, there is a calculator on the website that can look at expenditure and savings and then actually work out specifically how long that customer could last and survive on their savings, which is is a real sort of disturber with the customer to say, well, actually, I'm going to last a month.
Yeah.
If I maintain my current lifestyle, which again just drives home that message of, should I just protect the mortgage or should I be looking at something extra, whether that be IP or family income benefit to be more cost effective. So the tools are out there, I think, but it's like you say, I think it's almost going back to a bit old school.
It's fact find, isn't it? And again, if you're doing a mortgage with MMR, it's the use of things like budget planners, because that will throw out the obvious things, which mean actually that is your lifestyle. Right, to maintain that lifestyle, what other things should we talk about and consider putting in place? And I think, again, once you have that process, that journey, the client understands what's going on, what you're going to talk about, when you're going to talk about it and why, then, right, okay, yeah, I'm invested in this process. And then it's back to allowing them to make an informed choice and all the tools that are available in the marketplace.
Okay, excellent. Final 10 minutes of today. Wanted to touch on critical illness and severity-based critical illness, because we know that it's still quite a hot topic and a big debate about is one better than the other. I'll come to Nick first, as obviously the pioneer in that market, but we know a few of the others have gone. So Nick, if you could just talk us through why you think severity works well.
The first point I'd make there, Martin, is that actually every critical illness policy there's ever been has been severity based. There has been a hurdle which you've had to get over to be able to claim, and if you don't quite get there, you don't meet the definition, you don't get your claim paid. So with serious illness cover, what we're doing is moving those hurdles, putting them in a position where they reflect the impact of the condition now. And also, what it importantly does is allows us to pay out earlier in the progression of an illness. Too much inconsistency has grown into the critical illness market in terms of you could have a stroke and survive it with minor, if any, permanent deficit that's noticeable, and you get the same payout as someone who's paralysed from the neck down. Take Christopher Reeve, for example. That doesn't sit true with the fundamental principle of insurance, which is to put the person back in the position they were in. Now, I think what we've seen is the market moving towards us in terms of the addition of partial or additional payments, which is great, but I think our next challenge as an industry in terms of what we deliver to the customer, we've moved away from this numbers game. We've moved away from the myth that was ABI plus. What we've got to start doing now is providing greater, living up much better to what the customer expects. If a customer is diagnosed with a condition, they expect a payout, and unfortunately a lot of definitions don't give them that payout. So having a smaller payout on diagnosis is going to better meet customer expectations, and I think that's where we've got to move to. And the industry has done it. It's done it with heart attack and it's done it with stroke now. I think we'll see perhaps more innovation coming into the market moving forward. But I think having choice is good. For some customers, they want that certainty of 100% all or nothing payout, whereas others are looking for something else. And if we can provide them with both, then we're doing a good job. But we've got a long way to go. Illness is changing. Outcomes from illness are changing dramatically. You go back to 71, a woman diagnosed with breast cancer had a 50-50 chance of living for 5 years. Even by 2001, that was up to 80%. So these illnesses are changing, and we can't ignore parts of the body anymore. Things like gastrointestinal disease, very big. A lot of people suffer with problems, things like ulcerative colitis, Crohn's disease. They have an impact on people, and they expect, and people would expect a payout. And I think, ideally, income protection provides the solution here. But we were talking earlier. If you looked at an article 30 years ago, it would say exactly the same as an article on income protection written today. We don't sell enough. And what are we going to do about it? And no one's got the key there. So at least we can do something.
And I think picking up on that point, I think there needs to be a lot more merging of those two particular products, critical illness and income protection. And I think, again, if you go back to mid-80s when kit came into the UK market, how it's very complicated, there are only a few providers, it then became like the default product for mortgages. We then went on this race of how many events have you got, ABI 2003 to try and simplify. We're now sort of back into the race, whereas, for example, with Friends Life, we have stepped back to say, no, let's look at the pertinent events and actually focus on those with the best definitions. But I still think that we need to make sure there's a portfolio of cover. It's not just put all your hat on critical illness, because actually what you need is a combination.
Yeah.
So actually if it's something permanent, then actually you have that replacement income as well.
Yeah.
And it's trying to think more about a portfolio of, and that can extend perhaps to private medical insurance as well, given the pressures on the NHS. But it's having that range, and again it's back to lifestyle benefits, as Nick was saying earlier, things like whether it be best doctors, global treatment, all these other components. So hopefully that way clients have more financial and medical independence in the coming years. But it's a complex market, and I do think, again, it's back to tools, what are available. But again, things like CI Expert have helped, and us as providers need to make sure we can provide members and advisors with that knowledge so they're confident about the different conditions. But it is focusing, again, as Nick was saying, on perhaps some of the additional events. So if it's not a permanent, then actually during that initial blip, there is a partial payment which actually gives somebody that financial ability to get through that initial stage.
Well, if more people are paying out on severity, and then people improve their product, so an advisor might want to take out a new product, maybe even from the same provider, because it's now got better conditions. The fact that severity will mean that potential to claim more often, will that discourage providers from accepting that because they can see that there's a bigger claims history? Would it push more people into your area? Because you see your advisors look at a policy that was written 5 years ago and say, well, actually, whilst the premium's good, this new policy is fantastic.
Yep.
But if you've claimed 3 or 4 times on severity based, will you be able to re-broke that?
I suppose with those, obviously part of it's back to underwriting. So if there has been a claim, that's going to impact on potential eligibility. The other thing that I think, again, talking about underwriting reinsurance, is that I'm sure all of us would love to be able to say, if we're making enhancements to policies, let's make them retrospective. However, back to reinsurers, back to risks, back to medical advances. Unfortunately, generally, that cannot be done because of the cost base, the risk, the mechanics that were involved when we did that previously.
Yeah, and often you haven't, if you had an illness now which wasn't covered before, you haven't underwritten for it at all, and that creates an issue.
Yeah.
Indeed.
We do try to do it where we can in a cost neutral way, because obviously we can't change the premium.
No, absolutely.
But as books get bigger and bigger, it becomes more difficult. I think one of the things I know advisors get concerned about is complexity of different products.
Yes.
And I don't dismiss it, but what I say is what's more, there's nothing more complicated than a customer thinking they were covered for something and then not being covered for it. And I think it goes back to what I said earlier, what we've got to do is at least live up to what the customer expects and deliver to them when they expect us to deliver to them. And if we do that, and if we can go further with the added value benefits, then I think we can continue to grow this industry.
I think that was the challenge for advisors when people were on that race to how many ABI pluses can we have.
Yep.
That you could recommend one that had got 3 ABI pluses, but they had a claim on the one that wasn't a plus, but somebody else had that as a plus. So there was that feeling of, well, we can't foresee what illnesses, unfortunately, people are going to have in the future. So there's always going to be that balance of trying to understand, and I think that's where some members get a bit confused. And you're right, CI Expert will help with that on the critical illness. Is the fact that some of the policies can look quite confusing, and a lot of the things in there probably very rarely will ever get claimed upon as well. But it looks quite good to say you've got a lot of policies, and I think speaking to actuaries, the same. If you could do a simplified version, it would be great. But however, it'd probably still be the same premium as one with 50 covers because of the fact that they don't actually get claimed on as often. So you'd still be insuring the core 90% of things that get claimed on, don't you? So
in the old days, on the old mortgage endowments, they used to have sure you'll remember, but you're too young. But you used to be able to choose core cover if you wanted critical
Yes.
illness or
Yes.
additional cover,
Yeah.
and everybody took additional cover because advisors thought, well, if that had cancer, heart attack, the big five, but if that person has one of those other illnesses, am I going to get sued? And so it didn't work, and unfortunately, I don't think that's an option here. I think selling people, if affordability is an issue, sell them some
Yes.
critical
Yes.
serious
Yes.
illness cover. Don't always have to match that
Yes.
amount of mortgage.
Indeed.
Give them that safety net,
Yeah.
as Mark was saying.
We find
earlier.
that in the decline market as well, where people, because obviously the premium is going to be loaded, and affordability then can become an issue. So one that's, well, okay, at least have part of it, so that you've got half the cover or 2/3 of the cover or whatever it might be, so that at least you've got something, as you say.
Okay, on that positive about still managing to upsell at some point, we come to the end. So thank you, Nick. Thank you, Emma. Thank you, Martin. Thank you, Mark. I hope you enjoyed it. I hope it was an interesting debate and opened up a few areas for you to consider and look at. Your CPD certificates will be emailed to you, and also a link so that you can watch again and pick up on any of the areas that you didn't miss. So thank you for listening. And one final point would be, make sure that you've got Simply Protect. Thank you.